Corporate finance practice problem using OneNote. Net present value, NPV, delayed payments. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side. We're in the practice problems down in the 1227 net present value NPV versus internal rate of return IRR problem 1 tab. Also note, when using OneNote, look at the tool of the immersive reader. Our presentations up top will be mirrored down here in the text area. The text area having the same name and number, being transcripts down here, transcripts that can be translated into multiple different languages and either listened to or read in them. Closing out our icon, we have our information up top. We're going to go through the calculations for them on down below. Similar scenario that we have seen in the past where we have the initial investment, in this case that being the $80,000. You could think of that initial investment as something like putting money down on equipment, putting money down on a project, putting money down on inventory, something that's going to result in long-term returns into the future for multiple different years, in which we might then, when considering the project, want to think about the time value of money. The primary two tools, the primary calculations that we have to do that being the net present value calculation, the internal rate of return calculations. The two tools we'll look at this time, they are related. You want to know how they're related. So we have the cash flows down below. So we're going to assume that putting down the $80,000 is going to get us $45,000 year one, $37,000 in year two, $25,000 in year three. These are our estimated cash flows in the future. The discount rate, which could also be called the hurdle rate, you might see it called the required rate of return, the cost of capital, that's going to be the 12%. Now that 12%, when we use the net present value calculation, is going to include in it what we expect the return to be. In other words, that's not just the inflation, right? Inflation normally is like 3% or something. Here, we're talking about the rate of return we expect to get. Therefore, when we do the net present value calculation, if we come up to anything above 0, then we have cleared that rate of the 12%. That can be a little deceiving given the term of the present value calculations, because that term leads people to believe that we're talking about only the purchasing power of money, talking about simply inflation. No, we're talking about the 12% being included. Therefore, if it's even 0, that means we cleared the 12% and possibly could take on the project. The general rule that you want to keep in your mind between the net present value calculation and the internal rate of return is that the net present value, if anything is above 0, will be that you have cleared the rate, the 12%, and possibly would then take on the project. If it's something greater than 0, then you don't really know what the rate of return is that you're getting. You just know that you cleared the 12%. The higher the number, the better. If you had multiple different projects, you might then accept multiple different projects that are above the 12% if you had the money to invest in them. But if you have multiple different projects above the 12%, and you want to then compare them further because you can only put money in one or two of them or something like that, then you might want further analysis of what the actual return is on a percentage basis, which is the internal rate of return. So then you might then go down to the internal rate of return down here and say, well, I know I cleared the 12%, but what is the actual return I'm getting? And then compare that to multiple different projects as well and see further valuation, see what you want to do from that point. So let's do the net present value first. We're going to do our series of payments. We got 0, 1, 2, 3, and 0 being the amount, the time period where we put the money into the project. That's the 80,000. 80,000 represented here as a negative number, the money we're putting in at time period 0 to get a return of 45,000 period 1, 37,000 period 2, 25,000 period 3. If we were to sub up that series of payments, the positives minus the negatives, we'd have 27,000 at the end of that 3-year period, positive net gain, not taking into consideration time value of money. Let's take into consideration the time value of money. So I'm going to do the time value of money calculation on even the 80,000, which you wouldn't do if you weren't doing it in Excel possibly, but if you were doing it in Excel, that can be useful because then you could copy this down. So note it's useful to have the cell reference over here and then do your calculation on the 80,000 and then simply copy it down if it were in Excel. We do this in Excel if you want to take a look at that. We've got the negative present value, and then we're picking up the rate. That's going to be the 12%. I made that an absolute reference here with a dollar sign before the B and 9. That means when I copy it down, that 12% wouldn't move down in Excel. We have the number of periods, the number of periods being 0 in this case. Notice I'm referring to it over here, not with a hard-coded number, so that when I copy it down, it then picks up the next numbers as we do so. And then we have the payment skipped because it's not an annuity but present value of 1. The future value then being the 80,000. Same result is given here, but once again, if we did this in Excel, we could then copy it down nicely, as we'll see in the second tab. Also note that you could do these present value calculations as we saw in the present value section with a table or with the mathematical formulas. However, that would be quite tedious to do. So it's not often the way you would like to do it. Even practice problems don't often make you do long types of problems that way. So, but you could do that here. We're just going to do it one way. If you want to practice your present value calculations, then you can go back to the prior section and see how to do those multiple different ways. So then we could do that for this one on period 1, 45,000, bringing it back. Formula looking something like this. Present value of the rate, 12%. It's an absolute reference with the dollar signs here, so that if I copy it down, it'll follow down, comma. Number of periods is now 1. That cell moving down as we copy it down, comma, comma, because it's not a payment. Future value then being the 45,000. As we bring that back, we get to the 40,179. If we do the same 2 years out for 37,000, we get to the 29,496. If we do that 3 years out for the 25, we get to the 17,795. If we sum that up, then we then get 7,469. Once again, that does not mean that we're only getting 7,469 after taking into account inflation, the value of money going down, because this 12% includes our return. Therefore, even if this was 0, we would have cleared our return, and it would be something that we would think about basically putting money into if this was our hurdle rate or our cost of capital. So now that it's the higher the number this number is, however, the better. Now at this point, I know I cleared the 12%, and I know I like this number being higher if I compare it to other types of projects. The higher the number, the better, but I don't know exactly what my rate of return is on a percentage basis. That's what the internal rate of return is. So we can imagine then seeing this here and asking ourselves, if I was to compare this with other projects, I would like this number to be higher, but even if this number was higher, if I compare projects that have a different amount of investment, for example, it can be kind of deceiving as to, what my rate of return is. So I might want to calculate the internal rate of return to compare then multiple projects. The internal rate of return is the rate at which, the percentage rate at which this series of payments would be 0. That's the internal rate of return. You can think about that intuitively using a goal-seek type of method. You can think about that using a method, a function within Excel. It's another calculation that would be quite difficult, or it's a long calculation to do mathematically. You can do it, but again, even book problems don't often ask you to do it mathematically because, in practice, you don't do it mathematically. You kind of know it intuitively, and then typically we'll use tools to basically do it. Before we go on to that, also note, however, you have a net present value calculation here that you could use as well. This is a function in Excel. I don't think it's as useful because you still have to format your information into basically a table anyways. And if I was to do that, I would rather do the present value calculations in this format so that I can have more detail about what is going on from period to period. But if you have your series of payments like this over here, you can take equals the net present value of the rate. The rate would be the 12%, comma, the series of payments, which is a little tricky because we're not picking up the negative number here, but just these three, the inflows, everything after period 0. Close that up and then add to the period 0, the 80,000, the initial investment. Now, when I add that, I'm adding a negative number because it's a negative number here. If you want more detail on that, you can take a look at this in Excel. We do it in Excel. Then if you were to think about this in terms of the internal rate of return, one way to get there would be to simply change this 12% to whatever percent it needs to be to get your net present value to 0. So you could do that with Excel, or you could do it kind of manually and basically keep on increasing this 12% until it gets to your net present value calculation being 0. If you were to do that, we would get up to the 17.93. Again, you can do that in Excel using a function called goal-seek. I think that's one of the more intuitive ways to do that because it does give you a good idea of the relationship between the net present value and the internal rate of return. So this 17.93 would then be the rate at which the net present value is 0. Now, you could also do the internal rate of return with a formula, which I do find a useful formula. And to do that, you'd have to set up your payments in this format. And then just simply, once you set up your payments in this format, it's a nice, easy formula. Your negatives for the outflows, positive for the inflows. Then you just say equals IRR, and then it's like the sum function. You pick up the range of data, which would be the 80,000 through the 25,000, not including the total. And that would also give you then the 17.93. Note that if you did it this way, just with a formula, many people don't really understand what that number means. And I would still want to double check it myself. How do you double check it? Well, the easiest way to double check it is to plug it into the net present value calculation. You could do that with a formula, meaning you could do the net present value formula down here, which I don't find as useful. Would be the brackets, would be the rate. The rate would be this number now, 17.93. And then comma, the range. You got to pick up the range, not including period 0, the 45 to the 25. And then close up the brackets and add the 80,000, which is a negative number, basically subtracting the 80,000. That would give you 0 because the IRR is the rate at which this series of payments would be 0. Or you could set up this table, of course. Same process. If you did this first, the internal rate of return first, then I would set up the table and calculate the table as if this was the rate, expecting that the end of the table should be 0 because this 17.93 is now built into the return, just like this 12% was. So that means that this being 0 means that we're getting a rate of return, the internal rate of return of 17.93, because that's the discount rate that we used in order to generate the net present value table. So you can see how these two things are related in practice. You might do the calculation in that format, right? You might do the net present value, which is the standard calculation to see if you clear the hurdle rate. And if it does clear the hurdle rate, you might then say, I would like to know exactly what the rate of return we're talking about is, possibly to have a better comparison to other projects, some of which I might be trying to choose between them. And then you could go and do your internal rate of return. The higher the internal rate of return, the better. So if I had two projects that cleared the 12%, one being 15% internal rate of return, the other being 17.93, then I would like to take both of them on if I have the money to do so. But if not, then I would want to possibly choose the one that has the higher internal rate of return. That one will usually also be the one that clears the hurdle rate by a bigger dollar amount. But that may not always be the case if we have projects that are different in terms of the initial investment and the flows that will happen in the future. So it could be a little bit deceiving here if you're comparing projects that are not similar in nature, and therefore the internal rate of return could be useful, could actually give you a different result and give you more information than you might have by just looking at how far one cleared the hurdle rate in terms of total dollar amounts.